Hi everyone. So welcome to the live stream today and welcome to our second installment in the IFRS masterclass that we started on Monday. In case you missed that lecture, you can check the description of this video to be able to watch that, or check the channel playlist. You will find the IFRS masterclass podcast on the playlist or on the channel, and you'll be able to get access to that and be able to get access to the content. Today we want to go straight up into our discussion and start with IAS 21, effects of changes in exchange rate. And I'm going to use that standard as a guinea pig to actually throw lights on other standards and find out how the standards actually connect with each other. So let's get excited into the discussion straight up, and then let's see what we can do. Let's get straight up into our discussion. IAS 21, effects of changes in exchange rate. So what is this standard about? It's an interesting accounting standard that we need to know about and realize how we are going to be doing the various treatments in respect of this particular standard. So the main thing about IAS 21 is that it governs transactions it governs the treatment. Let me put it that way. It governs the treatment of transactions. It governs the treatment of transactions in foreign currency. So anytime an entity undertakes transactions denominated in a currency other than the reporting currency of the entity, then that is going to be treated in accordance with the guidance in IAS 21. It means then that we have to know about what we refer to as the functional currency, or if you want, the reporting currency of the entity. Because if we don't know the functional currency or the reporting currency of the entity, then it will be difficult for us to actually work with the transactions denominated in the foreign currency. So when we say functional currency or reporting currency, what exactly do we mean by that? Now, the functional currency is simply the currency, okay, the currency of the primary economic environment in which the entity operates. The currency of the primary economic environment in which the entity operates. That is the functional currency. And I'm coming in from our corporate reporting or financial reporting book that we have. That is where I am coming in from in this slide here for my presentation. So if IAS 21 is governing the treatment of transactions that are denominated in a foreign currency, then the question we ask ourselves is, what is the functional currency? The functional currency is the currency of the primary economic environment in which the entity operates. So the question we then ask ourselves is, how do we know about the functional currency or the reporting currency of an entity? The good news is that IAS 21 provides some guidelines on how we can determine the functional currency or the reporting currency of the entity under review, because that is the starting point. It is only when we are able to know about the reporting currency or the functional currency of the entity, that is where we can then translate the transactions and know the way we have to treat these transactions. So, determination of the functional currency. So determination of the functional currency of an entity. So IAS 21 gives a couple of guidelines. So I'm going to be pulling that up and then we look at it quickly. So these are a couple of pointers that we look at. Let me zoom it back in so we can see here. 1, the currency that mainly influences sales prices for goods and services. That's the first thing. The reason why we need to understand this well is because sometimes the entity will be trading in multiple currencies. And so it is important we understand which of the multiple currencies that an entity is trading in that will be used to report or account for the transactions in their books. So, number one, the currency that mainly influences sales prices for goods and services. The currency that mainly influences labor, material, and other costs of providing goods and services. That could also be a guiding principle for us to determine the functional currency. And then the currency in which funding from issuing debt and equity is generated. So if the entity is issuing shares, the entity is issuing bonds or other debt instruments or other forms of financial instruments, which currency is primary dominance on in relation to the money that they are going to be getting? Is it in dollars? Is it in Ghana city? That is going to guide us. And then the last one is the currency in which receipts from operating activities are usually retained. The currency in which receipts from operating activities are usually retained. So if we want to determine the functional currency of an entity, if we don't know about it, then these pointers may guide us in the determination of their currency. It then means that broadly, foreign transactions will then be divided into two key categories. So we have what we call monetary items and then non-monetary items. Now, it is important we set this up because the treatment of monetary items will be different from non-monetary items. So it is important we know about this. So when we say monetary items, what do we mean? So let me give you just a one-liner definition here. When we say monetary item, it's the unit of currency held and assets and liabilities to be received or paid in fixed or determinable number of units of currency. In a simple language, monetary items are things that can be converted into cash. So examples of monetary items can be referred to as, for the purpose of this particular treatment, can be issued in relation to, trade receivables, okay, trade payables, all right, other liabilities. These are all going to be monetary items when it comes to accounting for them. And we'll get into how this will apply later on. Then on the flip side, the non-monetary items are the items that we cannot receive or pay in a determinable future amount in relation to that particular item. So what does that mean? It means that all various non-current assets will be classified here. So our property, plant, and equipment, our investment property, all these things may be referred to as non-monetary items. Inventories may be regarded as non-monetary items.